And we'll see as this correction in the market turns into a recovery, we'll see if this is what continues to happen. It started to after the election. The tariff turmoil caused a bit of an upset. But I think coming out of this, especially if we're right that inflation's coming down, the economy is going to recover nicely, productivity leading the charge, thanks to these technologies, we think this headwind will dissipate as well, and that the bull market will broaden out.
For nearly 2 years, U.S. markets have been propped up by a handful of mega-cap tech giants, leaving much of the market and many crypto assets behind. This market concentration has sparked frustration among investors questioning whether we're in a bull market or if a deeper bear phase looms. Cathie Wood of ARK Invest believes this narrow rally is unsustainable and lacks the breadth of a true market recovery. However, Wood sees signs of a shift as inflation cools and transformative technologies like AI, automation, and blockchain emerge as powerful growth drivers. These advancements are laying the groundwork for a broader and more sustainable recovery, extending opportunities beyond big tech to a wider range of sectors, including innovative crypto projects. She predicts this evolving dynamic could mark the start of a new bull market in 2025, driven by falling inflation, rising efficiency, and investment in undervalued areas of innovation. This could signal an inclusive growth phase powered by both traditional and decentralized technologies.
Introducing the all-new Ledger Flex. Your next-level crypto wallet is here. Sleek, premium, powerful. The Ledger Flex delivers a solid, high-end feel with smooth edges for a more comfortable grip, and that satisfying nostalgic sound you didn't know you missed. Still clicking away in your old Nano S? It's time to upgrade and lock in your crypto gains with style this bull run. Smooth, modern design built for serious profit. Click the link below to grab your exclusive Ledger Flex. Ditch the rest, go Ledger Flex.
Trueflation CPI versus the US CPI. Now, trueflation CPI tends to pick up on inflation before the US CPI, 3 to 6 months before. And you can see here, even with all the tariff turmoil, inflation indicators, this one at least, are pointing down. The last reading, I think, was 1.37%. Versus the CPI, which is a little over, I think it's at 2.5%, a little over 2.5% right now. That's the green line. Trueflation is the purple line. It's pointing down. And as we've been saying for some time, burden of proof has been on us because we did have this flattening out for a while in the 2 to 3% range. But we thought it was going to resolve to the downside. And here it does seem to be doing that. And we wouldn't be surprised to see negative inflation, just like we saw right after COVID and in late 2015, or no, that would have been early 2015 when there were some real scares about China, China exporting deflation. We think some of that is going to happen, China exporting deflation. As its economy is being hurt here, I would say rather badly, by the tariffs, and the technologies all coming together and creating a productivity boom, which we think is going to lead us out of the recession and create a really virtuous cycle, productivity boom, unit growth going up dramatically, and inflation coming down, maybe into deflation. So we also explain in the letter that our kind of strategy, any innovation-based strategy not wedded to the broad-based benchmarks, has had a very difficult time facing 3 major headwinds during the last 4 years. One was interest rates. We think they're coming down. The second was the concentration in the market towards, a very few names. And those tended to be very cash rich, larger cap names. We think we're at the end of that headwind as well. And we'll see as this correction in the market turns into a recovery, we'll see if this is what continues to happen. It started to after the election. The tariff turmoil caused a bit of an upset. But I think coming out of this, especially if we're right that inflation's coming down, the economy is going to recover nicely, productivity leading the charge, thanks to these technologies, we think this headwind will dissipate as well, and that the bull market will broaden out. I would describe the bull market through 23, 24 as I know anyone wedded to the benchmarks won't agree with this, but as an unhealthy bull market. It was not broad. In fact, it has never been less broad. It was worse than the depression level concentration as measured by this Goldman Sachs study. And now we think it's going to broaden out into a healthy bull market, as it did from 32 to 36, 39, into the 40s, the late 60s. The exceptions were 73 and 2000. They ended up in a bear market. But even 09, which I remember very well, it broadened out into market recovered, and the recovery was very broad. The last chart in the letter, we have more charts here and we'll go quickly through them. But the last chart in the letter talks about the third headwind. So the first was interest rates. That's gone. The second was concentration in the market, fear causing a shift towards very few stocks, cash rich, large cap. And we think that's dissipating. And then the third is certainly the valuation headwind. And you can see innovation-based strategies are at near record low valuations. When I say record low, this is the history of ARK's life, but innovation-based strategies broadly are selling at a very low premium to the S&P 500 as measured by enterprise value to adjusted EBITDA. We worked with S&P 500 to adjust for stock-based compensation and R&D, both the S&P and the various innovation strategies. And you can see very, very modest valuation premium. The average over the life, or at least ARK's life, on this metric is roughly 90%, I think, taking out COVID, the COVID distortion, it's 75%. So innovation, we would say, is on sale.
Cathie would seize signs that market pressures like high inflation and concentration are easing. Inflation is dropping faster than official data shows, possibly heading toward deflation, helped by China's economic struggles. Breakthrough technologies like AI and automation are boosting productivity, which could drive a strong economic recovery. She also notes that interest rates are falling, markets are broadening, and innovation stocks, including cryptocurrencies like Bitcoin and Ethereum, are undervalued. This makes now a great opportunity to invest in innovation as markets prepare for healthier growth ahead.
And here are our expectations of what the broadening out of the market will mean. You can see that the Mag 6 from 2019 to 2024 tripled in market cap, whereas the rest of innovation, and we would say truly disruptive innovation, lagged badly. It was only up 30%, not even a double. You can see that we expect the Mag 6, not all of them. We worry about Apple, as we've told you many times, somewhat Alphabet as well, but all of them will be touched in some way by disruption to the traditional world order. Nonetheless, we think they will deliver good returns over time, but we do think it's now time for truly disruptive innovation, this broadening out of the market to reward the true disruptors. And so we expect more than a tenfold increase during the next 5 years in the market cap of those. And you can also see the rest of the market, we think, which really represents the traditional world order, will not see much appreciation, if any, on balance. In terms of the bond market, here's the very long term. We were in a bull market for 40 years, and we've come out of that bull market. And the question is, where now? And I want to show you a few charts. We think that maybe we're in a new normal that will be in the 2.5 to 5% range as we go into a world of perhaps stronger than expected unit growth, but lower than expected inflation. And if you look back at the last time we were in such a period, massive innovation, the 50 years that ended in the roaring 20s, what we saw was an inverted yield curve. Most of the time averaging 100 basis points. But short rates mirroring nominal GDP. So if nominal GDP is in the 4 to 5% range, maybe that's short rates. Inverted yield curve would be 3% to 4% long rates, and so forth. Just an idea. Here you can see a lot of people think we're in this massively inflationary world, and we're just not, as measured by commodity prices. You can see we are today where we were back in the 80s, back in the 90s. The real inflation was when the Fed in the late 90s responded to long-term capital management imploding, to Y2K, the fear of that shutting down the global computer network, and then finally the tech and telecom bust. So the Fed drove a really inflationary policy back then, but it has not since then. We had, of course, the supply shock during post-COVID and during COVID, but we've settled down since then. And then finally, always like to talk about Bitcoin to gold. And again, gold going parabolic did take this ratio down. But you'll notice that it did not break the uptrend that is in place and that we think will remain in place. Bitcoin did act more as a risk-on asset in the market's recent correction. It behaved like the NASDAQ, unlike gold. But we believe that it was just correcting to this trend line because the Bitcoin price went up so much more than the gold price last year. So we think that this trend line will continue to move up if we're right that we're moving back into a risk-on environment. Now, why did gold act as risk-off, but Bitcoin not do so? I just described one reason. Bitcoin was way ahead of the gold price, so that is one reason. But I think the other reason is we weren't in a financial collapse. We were like 08, 09, and the banking system was or the counterparty risk in the banking system was not called into question. So we think the flight to safety into gold was more of a, hey, let's readjust and get this back into some kind of trend line. So with that, I hope I've conveyed we're really excited about how the market is beginning to shake off three headwinds: interest rates, convergence or narrowness of the market, and valuation. And we think that we're being set up here for some important surprises to the upside, as many strategists and economists worry that we're heading into a recession. We'll be talking more and more about the productivity-driven recovery that will spell the end of the rolling recession.
Cathie Wood and Raoul Pal see clear signs of a market turnaround with falling inflation, lower interest rates, and growing investor confidence. This could spark a broad recovery led by tech and crypto, moving away from the narrow focus on megacap giant. Indicators like bond yields and commodity prices suggest we're past the worst inflation shocks, pointing to steady growth rather than a deep recession. If this trend holds, innovation stocks and cryptocurrencies may lead the next bull market, bringing new opportunities and wider market participation. The big question is whether this is just the start or if caution is still needed. What do you think? Are you ready to invest in this potential recovery or staying cautious? Is this the start of a new tech and crypto bull run? How will you adjust your investments in this changing market? Do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.